I was reading Ackman ones too.
This meeting is being live streamed. That means it's value after hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Jason Buck of the Mutiny Fund. He's an expert in volatility, hair care products, various other things.
Very handsome fellow.
How are you,
Appa-
Jason?
I'm great. Apparently, I didn't get the memo though on the Christmas, the Santa hats. So I apologize. No Christmas sweater, Santa hats, but I'm unfortunately traveling in Chicago right now. I'm on my way back from California and got shot out for Jeff Malik at RCM and the Derivatives podcast. I'm using his office today. So, but otherwise, happy holidays, fellas. Happy to be on and talk end of the year festivities, even though I'm not sure it's an exciting year for any of us, but we'll try to keep it positive.
A lot
It
of
was an
people are having good
exciting year.
years.
Yeah,
I don't know if it was a good year. Let's talk a little bit
yeah,
about let's talk a little bit about, so your Mutiny Fund volatility, just for the folks who haven't encountered you before. What is volatility and what is your unique take on it
sure.
in Mutiny Fund?
The simple way to look at it is like our flagship fund is called the Cockroach Fund, and the idea
Great
there
name, by the
is,
way.
yeah, thank you. The idea there is offense plus defense wins investing championships, and we find that most investors have a pie chart of diversification, they think, but most of that's just purely offensive assets that get hurt in liquidity crashes like March of 2020 or in protracted recessions or inflationary environments. So we try to pair defensive strategies with that offense. So on the defensive side, we specialize in long volatility and tail risk and commodity trend following. Long volatility and tail risk are usually option strategies that tend to have really convex profile payouts, similar to insurance or like a portfolio insurance when markets crash. And then commodity trend following tends to have a higher beta to inflation or recessionary environments because it has a kind of a 1-2 punch, but it's more of a little bit longer lag than you would get from the immediate convexity you get from like long volatility and tail risk. So we think those are the two that pair really well as defensive assets to pair really well against your stock and bond portfolios. And then so when markets are ripping higher in both stocks and bonds, it's tough to the defense tends to be a little bit of a drag on the portfolio, but it's there to hopefully jump you out from behind the curtain when you need it most. And the way we think about it, most importantly, is that it's reducing that volatility tax to your portfolio, meaning like, when drawdowns do happen in a stock or 60/40 portfolio, a lot of people panic right at the bottom, so tend to crystallize those losses and not get back in on the subsequent run-ups, and that really tends to kill their compounding over their lifetime. And so that's what our focus is on, is maybe by having some defense in your portfolio, you can have a little better peace of mind and make better decisions when markets are crashing and everybody's panicking around you.
So you always have something that's not working in the
Exactly.
portfolio.
Yeah. What's Brian Portnoy says, true diversification means always having to say you're sorry. And
Yeah.
so, yeah. And yeah, it's difficult to benchmark those things, all that sort of stuff. So it's like, yeah, it's just a lot of just I get up in the morning and I run face first into a wall every day. It's a joy.
Did CTAs in 2022 work? I know that the tail risk products
Yeah.
kind of didn't because it was too slow of a meltdown, but did CTAs capture that slow meltdown well?
Yeah, that's a great point. So like see, like your long volatility tail risk is great for like that sharp liquidity crash, like we were saying March 2020. But then if you have a 2022 where you're slowly dripping down, right, and the realized vol is not outperforming the implied volatility that you pay in the options, it's a difficult environment for long volatility and tail risk in a 22. Like you absolutely nailed that, and that's why we like that 1-2 punch with the commodity trend followers. Is that's where they tend to do well. Is either in a protracted recession or an inflationary environment, getting a little bit of both in 22. Yeah, most CTAs, I'm trying to think of what I could say in a podcast, were up well into the double digits in 2022. So they were a nice ballast to the kind of that drawdown that you got in stocks and bonds in 22.
And then how often is the rebalancing that you do to kind of take advantage of the Shannon's demon part of
Yeah.
the equation?
So in an ideal world, like the way we look at it is we're like kind of a modern interpretation of Harry Brown's permanent portfolio. And Harry Brown had, rebalancing bands. It was like 25% each stocks, bonds, gold, and cash. And if any of those bands got out of whack by like 10%, then he would rebalance. And that equaled about like once every 1.3 years, I think, over like a 34-year period. So I really like those rebalancing bands in general for these broad asset class diversification. But we offer our clients monthly liquidity, so we actually rebalance on a monthly basis. But that's kind of great. So like if you have, a March 2020 scenario, stock sell off, you get this convex cash position with your tail risk puts, you're rebalancing April 1st in a systematic way, which forces you to buy those stocks at a lower NAV point, which helps your compounding over time. But more importantly, who wanted to rebalance into stocks April 1st, right? Like everybody, like emotionally, it's very hard to do. So we like that systematic rebalancing that we do on a monthly basis, even if it's maybe suboptimal. But like I'm sure you guys have looked at this. Is like anytime you look at rebalancing, whatever window you use will tell you the most optimal rebalance period. But then walking
Never
forward,
works going
it'll
forward. Yeah.
flip. Yeah, it'll flip.
Right.
What happened in volatility this year?
Another year of headwinds for long volatility tail risk. So it's been a really tough 5 years actually for like long volatility kind of tail risk funds. We've actually seen quite a bit go out of business in the last year or two. Um, the good and bad news about kind of like long volatility tail risk is kind of like Hyman Minsky, like Minsky like moments is like stability breeds instability. So as these markets continue to run up and we have a really low vol environment and we went, well over 400 days without a 2% down move in the S&P until we kind of had that like August 5th that I'm sure we'll get into. And so, during those environments, that's kind of a drag to have that long volatility tail risk. It has headwinds. And then as vol has kind of come down, post 2020, post 2022, those are further headwinds. And then you always have around election cycles, you have like a kind of increase in implied volatility that you're charged to kind of hold those positions so that when that runs off, you have a volatility crush that we saw again if nothing really happens with the elections. So generally slow or headwind-ish year for long volatility tail risk. I mean, I think it was post-election or even going into election in these last few months, we've been having intraday realized volatility in like 4 to 5% range. So it's just like without vol, there's not a whole lot vol traders could do, especially on the long vol side. So yeah, it's been generally a headwind for long volatility tail risk. And then I'm sure your next question is going to be commodity trend following. It was a great Q1 for commodity trend following, especially with the cocoa trade that kind of ripped higher. That's where a lot of the classical trend followers made money in the cocoa trade. I love like it's great being commodity trend following because you could pretend
Just
like
get
you knew that was
random
going to
stuff,
happen.
yeah.
Yeah, you just get total random stuff like rubber's ripping now too. So like you just never know. But actually, and then cocoa's back again. So it had a nice run up, then it drew back down throughout the rest of the year, and then cocoa's kind of back on the books again, and it's
Seasonal.
it's
Lots of
ripping
cocoa being
again.
consumed.
Yeah, who knows?
Sorry,
Yeah,
It's hot
sorry.
chocolate.
exactly. And so it's always fun, yeah, looking at all those commodity inputs. But so after commodity trend following had a great Q1 after, and then as Jake mentioned, they had a great 2022. But it's what have you done for me lately? Is through Q2, Q3, Q4, commodity trend following had one of its worst drawdowns in 30, 40 years. So that's why it's really hard to kind of hold these asset classes. So you're seeing, yeah, some of the worst drawdowns we've seen kind of across the entire space, and you can see that the indexes or the individual shops. So yeah, that's why I think maybe also why we never see, trillions of dollars in commodity trend following, right? Because they typically have these MAR ratios of like 0.2, 0.3. So they tend to have, they produce returns when hopefully you need them most. But then the drawdowns can be pretty rough for people to manage.
Yeah, how long do you think since volatility's really like that? I don't know, the blow up volatility, like the Taleb type volatility. When's the last time that really paid off?
March 2020.
Okay.
So yeah, that's when you saw like those ridiculous headlines of like 4,000 plus
Yeah,
percent
the goat
returns and
farmer.
everything. Yeah, it's March 2020. Yeah, that's on your monthly premium. So you would have lost 100% of your monthly premium for the
Yeah.
last 10 years prior to that. So that's some great reporting there. But that's when you saw the big
Antoine, that's
pop.
Antoine Gara.
Yeah, yeah. So
He's
these
the
are
reporter. Picks up on
yeah,
the goat on the goat.
yeah, and
Sorry,
like most
goat
of those
farmers.
guys had like those kind of
Criticized
returns
by
too.
category, Toby.
Yeah,
Sorry.
exactly. Yeah, I didn't know we're attacking by name. Yeah. So then,
He
so yeah,
puts them on, he puts them on the articles. I just read the articles.
yeah. So it depends on what flavor too. Like if you're talking about like that pure tail risk, yeah, it's mid-March 2020. When you're talking about relative value volatility or opportunistic long volatility, there's been pops here and there for people to make some money. It just depends on what they're doing. But otherwise, yeah, it's been besides that pop in March 2020, it's been a rough period because like once again, actually you would hope for this August 5th when the Nikkei tanked over the weekend, you would expected a pop in volatility there. And it was all in the pre-market hours. And as soon as the market opened, it crushed back down. So a way to think about this is in, you know, as we read our Bendwell Mandelbrot, like volatility, universe or it clusters, right? And when shit hits the fan, it tends to cluster, right? And you get these like outsourced moves, but then volatility over time gets crushed back down as markets quiet down. And so, after like the GFC in 2008, it took years for volatility to kind of quiet back down or for vol to get crushed back down. It, kind of slowly kind of took an angle glide path for the next few years for it to come back down. And then we had the, Volmageddon where maybe it came back down within a few months. And then August 5th, we had volatility crush back
An
down that
hour.
day. Yeah,
Yeah.
that an hour that day. By the end of the week, by the end of the month, the S&P's back up, or flat, like to flat or positive by the end of the month. So it's like it's just kind of crazy living in this world to see vol crushes happen so quickly. But then knowing at any time if that truly breaks the other way, that means people are not positioned for that, and everybody's positioned for buy the dip, and can have kind of all hell break loose if you get beyond like a 2 standard deviation on a sell-off. And then those market makers truly step away, and we have severe air pockets. But I'm not a fear monger. It's just like those things can happen, so we're always positioned for that. But in the meantime, when they don't, it makes it a bit of a tough headwind.
Let's talk about some of the wild things that have happened this year. I think that probably the story that, I mean, there's a few stories going on at the moment, but we were talking just before we came on about MicroStrategy, MSTR. They've been buying Bitcoin, and they use converts and various other debt and just straight equity issuance, ATM, at the market equity issuance to
I thought it was ATM like a cash machine.
It's both, yeah.
works the same way. um, to buy Bitcoin, which has then gone up, which then creates this virtuous circle, which to my mind, there's no way that you can lose in that trade. So you looked inside, you know it a little bit better than we do.
What are people missing there?
What's going on?
Well, I'm not gonna pretend I'm an expert, but I'm happy to talk about it. But yeah,
It's
I
a
didn't know.
podcast, don't worry
Yeah,
about it.
exactly. Yeah, nobody's watching this. Yeah, I thought with the Santa hats and everything, it was just going to be a lighthearted year in review. We're talking about vol CTAs and micro strategies. It has been interesting, like we were talking about before we came on, is how. And actually, it was actually one of your last shows where I started coming up with this idea of like, I studied comparative religions and how I'm kind of like agnostic to space, but like how each kind of unique investing strategy has their own religion, and you don't stray outside of that or you get smacked down by the herd, right? And so
Yeah.
it has been interesting. Like the Bitcoin maxis are obviously an annoying cult, but like they don't understand what like convert arb is. And so they, think it's just kind of like a long Bitcoin fund. But then people from more traditional finance, one, also probably don't understand convert arb. And they just think it's a proxy for a leveraged Bitcoin fund. So like nobody's really talking to each other or looking at what's actually going on, the nuts and bolts underneath. And so we were talking about before, like Corey Hofstein and I were really digging into this stuff, trying to learn exactly what's going on with us financialization. And I think that what's been really interesting is what kind of MicroStrategy stumbled into. This was not on their path or their plan, but like post the spot Bitcoin ETFs coming out of the market, you would have thought that they were kind of done. They were a good proxy for people to invest in Bitcoin that maybe didn't have other vehicles, and maybe that spot Bitcoin would have kind of killed them. But then they kept continuing on, so we had to look at like what was really going on there, and it just got to the point where they were just big enough, for these convert arb funds to be able to start buying in, and they started offering the convertible debt. And the volatility was high enough to really entice these convert arb funds in. And so what happened was they were borrowing, initially, I believe like their initial tranche when they did just pure debt, it was at like 6-7% interest. But then once they get these convert arbs and they start buying them in size, it got down to 1%. Now they're down to like 0% on these convert arb funds. And the convert arb funds, that is always funny because the Bitcoin side, they go, oh, these convert arb guys, they just love it because they love Bitcoin. They're trying to get a call option on Bitcoin. I was like, these guys couldn't give a shit less about Bitcoin. They just want volatility. And because they're leveraging up like a 50 vol asset, they're getting in this 120 vol range. And so that allows the convert arb guys to like delta hedge their positions, because at the same time, what needed to happen is you needed something the size of MSTR to have a liquid options market where these guys could hedge in as well. And so nobody else really has that liquid options market. And so, it's just getting the size where convert arb can participate. There's a liquid option market where they can start hedging their deltas and their positions. And they're just looking for this high vol asset, which that happens to be a leveraged high vol asset. So you kind of had this perfect storm that kind of converged. And so every time they issue more convert debt, these convert arb funds just keep picking it off. They'll take it all day long, and then they're just hedging their positions, and they just love this volatility. So to Toby's point, it's like, you start getting to like, when does this end? Well, one, it can run a lot farther, and there's talks of whether it's inclusion in NASDAQ or potential inclusion coming up soon. Maybe they'll announce like S&P 500 inclusion. Now you get all those passive inflows. I was actually looking up the other day. You guys might know this. The smallest firm in the S&P 500 index right now is American Airlines. I want to say their value is just shy of 10 billion, but like what I did look up is their passive inflows are 100 million a quarter. by being the lowest rung on the S&P 500 indexes. So then you start thinking the passive inflows. The other thing that may happen potentially shortly in the MSTR trade is if they develop a CDS option, CDS market on that, because that allows them to convert ARBs, even hedge more of their risk off. And so that would just have an explosion probably in value. And so you have all those things going on. And so now you have what's, for lack of a better term, an infinite money glitch. But like two things kind of solve this, or like how does it end? One, as you guys are, you're well aware of your history, is like the Hunt brothers, tried to corner the silver market. Well, there's rules on the CFTC side against cornering commodity, and so you can argue that Bitcoin's a commodity and this is cornering commodity. So you could have some sort of problems there as far as cornering that, which could shut it down. But then two, it's like at a certain size, this vol will come down, and then the convert ARB funds are no longer interested. And therefore, they start pulling all the convert ARB liquidity. Not only that, over time, it converts to actual shares, right? Which, as you guys know all too well, will dilute those shareholders. And then, like you said, those ATM purchases that more as retail is getting involved in, will that dry up over time? So there'll eventually be a bag holder. I wouldn't necessarily call it a Ponzi or a pyramid, but it's something like that, where it's just like it gets so big that it consumes itself, like it eats its own tail. And so if that vol tends to collapse over time, that's where you're going to see that trade really kind of shut down or turn off, at least from the participation on the institutional side with like the convert ARB funds and everything. But it's like, so you've had what's interesting now, you have, and I'm blanking on it, but there's a publicly traded equity in Japan that's trying to mimic exactly what they're doing. I think there's upwards of 30 different companies around the world. They're trying to mimic this in different stock markets around the world, because one of the reasons they're doing it in Japan and other places is because you have such high taxes on just holding Bitcoin in a cold storage wallet. But if you buy a publicly traded equity, you can reduce your taxes. Similarly, why people love MSTR is you can borrow against it as a stock. Like you have all these other financializations you can use around it. But I'm just not certain that the other ones that are trying to mimic MSTR got lucky enough to be at the size they were at to be able to get institutional participation. I'm not sure if you're running a $5 to $50 million market cap stock, if you can run the kind of same financialization playbook that MSTR has kind of stumbled into.
Can I ask a dumb question? What happens if Bitcoin goes down?
I don't think it's so like the leverage amount, if I had to look at it again, is so low. I don't think it matters. So the other thing is like, and I'm pulling these numbers from the top of my head, so I'm gonna get lambasted in the comments. But let's just say like it's 30 to $50 billion that they're holding in Bitcoin now. What if it tanks off 90%? Well, they're still holding that in their treasury, right? And they use convert ARB, so like now their cost of capital is essentially zero. So all they have is dilution on the back end. So really, is that a terrible trade for the board and for Saylor and MSTR? That's debatable.
No, I'm not worried so much about it. I just think that the MSTR price will go down a lot if that happens.
Well, yeah. Well, that's the other
claim.
Well, the other thing we were talking about before that I would caution everybody on, and that's what I was seeing too much of on Twitter X, is like people saying this is a no-brainer, ARB. I'll just short MSTR and be long Bitcoin. And they think that it's just the delta of like it being leveraged Bitcoin. But the things I talked about with the convert ARB, and if they get CDS, if they get inclusion, that can go from 3 to 4x to 10 to 12x, immediately, and you get your
NAV of
and you just get
Bitcoin,
killed
basically.
Yeah. And so that's a really tough trade that I've been trying to caution people out of, but I don't like to caution people on any trades, because what if it works? Then I'm the idiot that talked them out of it. So that would just be the caution, is like that multiple of Bitcoin NAV can dramatically increase. Like to your point, Toby, it could also come back. It could also collapse back in. I don't know the future, so I'm not predicting any of that.
If it works, you recommend it. If it didn't work, you didn't recommend it.
Exactly.
40% chance.
Yeah.
40% chance. Let me give a shout out to everybody at home. Brandon, Mississippi, what's up? Ballynamullen Island, great name. Petah Tikva, Israel, Cardiff, Wales, New Jersey, land of the drones. Yeah, what's happening out there? Humpy Bong, Australia, that's real. Georgia Strait. Jupiter, Florida. Good on you, Sam. You've already won. What are you doing on this? Jason is so beautiful. There you go.
Whoa.
We're gonna finally got some eye candy on this.
It is an all male audience though, Jason. So I don't know if that's your demographic, but
we have less than 1% females, so it's not zero. There is a chance. I've been watching I've been watching value stocks. I own a lot of them. But let's talk about a bigger
how's
index.
that going?
Yeah, now that you talked me through all my pain, let's talk about your guys' pain.
Yeah. Therapy
Um,
session.
the value S&P 500 value has had this record-setting nosedive while everything else has been taking off. I don't understand why can't value participate in one of these manias? That's what I want.
Show us on the doll where the market touched you.
It's been a long time since value worked. Gee,
I'm
back in
curious to get like
2009.
how you guys think about a lot of this. Like one, I saw Meb did one of his great polls the other day, and it's like when it's an up year for the stock market, what's the average return in the up year, right? And it had like 5 to 10%, 10, 15, like over 20. Like what would be your guys' guess? So I had to put you on the spot.
The average return in an up year, so that's
Yeah.
taking away the down years.
Yeah,
Yeah.
Well,
it's got to
like
be high. It's got to be
the
like
average
18 or something.
The average return is 9 across all years. Yeah, I wouldn't say it's fabulous. I'd say like 15 or 16, something like that.
But I love right away though. You guys get it right away. It's like the tyranny of averages. It's actually 21%.
Oh wow. Okay.
Yeah,
Yeah.
so like to give you an idea, like, and then what we were talking about before is like, 2022 was a down 18% year, right? Which got people nervous again. But it's like, what have you done for the day? Everybody's forgotten. And since the beginning
Yeah.
of 23, we're up 58%. We're up another
Wow.
28%
Yeah.
this year.
It's
Like it's
never
just,
9. That's the only answer. It's not,
yeah,
right?
exactly. It's never the average, right?
Yeah.
But that's why I bring that up. But like related to that though, I think on value is like I think we talked about before, like on another time or maybe privately, is like, when you had those growth value rotations, I always wonder like how much of those acute ones have been like those pod shops just rotating out. And that's why you see that quick cascade. And then you guys are feeling my pain of the mean reversion of all. Like that gets crushed back down. And everybody's like, no, no, it's finally the time. It's finally the time. And you see, you know, Toby and all your cohort come out on X Twitter saying
I
it's
don't
it.
celebrate. I don't
Yeah,
celebrate.
I know you don't. You've been in the game way too long. But like, but like that's what happened. Like for that to come back, doesn't it have to have a violent rotation and like bad shit has to happen for that to come back. So it's a
I
weird
think
thing, right?
you get to work before we get to work. The
Yeah.
volatility will be when you throw a party, then I will come because it'll be the value parties just afterwards.
I mean, that is a good question, though. Does value catch up or does everything else catch down?
Yeah, everything else catches down, I think.
Well, how do you guys think about though, like the whole passive debate and everything? We've been around and around this merry-go so many times, but like I'll give you an example where my other pain is like we use global diversification. So being in global
Mm,
stocks, this has been a nightmare, obviously, for the last few years. But like how much of that is driven by just pure US target date passive flows? Like, and so, but at the same time, those arguments are always the most succinct at the peak, right? And so
yeah.
it makes sense, like as you're seeing everywhere, the sentiment is like, do not buy global, do not even buy bonds, go 100% S&P as we're seeing sentiment at all-time highs. But we've seen this kind of game go around before, but like, do you feel it's kind of the same way as like it's because of those passive flows, that's why it's going to take something truly cataclysmic to bring value back?
I sort of think it probably will take something cataclysmic to bring value back because I think that it tends to work at the beginning of the cycle. I don't know that I necessarily buy the passive flows argument. I think that argument works right up until the point that it doesn't work. Like that argument will be true until the collapse, and then once we have the collapse, then it's no longer true. I don't know if I don't like the argument. I don't like an argument that's so long volatility. You know, that's it's terrible. Like the moment that goes the other way, the whole system is broken. And I think passive flows always follow the market. They always follow what has been working.
So we're all performance chasers in the end, is what you're saying. So when I see all of these charts for a 60-40 over the last 40 years, you're telling me that's just following the last 10 to 15? Is that way?
Well, I think you could get there from first principles. I think there's some Shannon's demon. There's a good argument to have some bonds or some fixed income with your equity allocation for the reason that you do have those down years and you can then provided you're rebalancing across those years. I think the rebalancing is the thing that makes it work because they're two uncorrelated assets.
Till 2022.
Yeah.
Then they got pretty correlated.
Yeah.
Yeah.
But that's and they're typically correlated during a higher inflationary environment. So that's the other thing to watch out for. Because like you said, over the last 40 years, stocks and bonds have been negatively correlated. So you had a positive carry put basically with the bonds. But then when those got down to zero and or when you have an inflationary environment, which if you look over 100-year cycles, they tend to be correlated more than they're uncorrelated, but it tends to tie in tightly pretty much with inflationary environments. We just haven't really seen an inflationary environment. And one could argue even if that post-COVID, especially 2022, is that really an inflationary environment, or is that just a supply chain shock from a global pandemic? It's hard to argue. I don't know the true answer to that.
Yeah, that's a good point. And I don't know the
Probably
answer to that
it's
either.
quite a bit of both, I would imagine.
There was this maybe helped us another way of talking about it. I think it was I think Man put out a letter in the last week or so that was interesting. It was pairing trend following with quality,
Mm.
but more AQR style quality, like long quality short junk, and kind of the way they look at it. And they're just showing how that's like a good pairing. But I wasn't so certain because like it was the idea of like your short junk would hopefully work during a liquidity cascade, and also those like the long quality doesn't go down as much. And I'm like, well, you probably want that like it's like you guys think about it. It's like you want value post the crash. Value before the crash is painful.
Yeah, it's a
Value in
pretty
the crash
pretty
too.
common refrain too. I think you hear today that you don't want to be long junky stuff into a recession. Like you want to own the best companies because they're theoretically positioned well, they're strong franchises, maybe even they come out of it stronger than they went into it, like the marginal player gets knocked out of the industry, etc. I can't help but wonder if that's been a little bit already priced in into a lot of these names. I mean, I don't know, Costco at 60 times, or great company, obviously, going to be a bigger company in 10 years, but you, you got to get to some pretty Herculean outcomes to even earn sort of a market return from that starting at a 60, but we'll see.
Do you think it's one of those times where it's like where like your Buffets of the world will take their ball and go home for a few years because they just can't find anything of value?
Well, didn't he do that already? I mean, he's at probably 400 billion of cash at the
Cash.
moment.
Yeah. No, I was just thinking like from your perspective, like I didn't mean to even choose him. It was just obviously top of mind, always easy to pull his name out of the hat. But you know, as those times when sometimes value investors write to their clients of like, I haven't found anything where yeah,
Mm.
for the like you said, the multiples are even too high on quality companies.
The risk with doing that is that
Yeah,
you run into an
you're
early,
seeing that from some managers right now.
but you run into the like the early 2000s type environment where the market was very, very expensive. You know, it's 44 times on a Schiller PE in 1999, 2000. And underlying that was a whole lot of really cheap stocks, really cheap value type stocks. Well, you know, they probably weren't even like value's probably unfair because they had a higher return on equity than the
Yeah,
rest of
the
the market.
cheapest decile had a higher return on equity than the highest decile.
They were better companies.
Do you think part of
And
that's like the tyranny of averages, like you just said, like you know, in the 20s, like you had high, you know, Schiller PE ratio, like, but like, why are we using that? And or like, I'm sure it's spanning your existence, like benchmarking to like an S&P or whatever. Like, all of those things are kind of irrelevant depending on your style, and like
yeah,
so, and averages over time. Like I said, like that's why I use Meb's thing is like in an up year, what's the average for the stock market? 21% because there's massive down years. Like, and so there's no average of like a 9% return.
yeah. But I still think I think it's so hard to know that you probably need to be doing something like what you're doing, where you're just exposed to everything all the time, rather than
That
trying
means
to
always
time it.
having to say you're sorry.
Yeah, but I just kind of think but that also means that something's working, and you're taking away from the thing that's working and putting it into the thing that's not working.
Right, but then this is the problem. Like we live in a world though of benchmarking to averages, right? And that's like you can't benchmark what we do, so it makes it really difficult when you're dealing with clients. And similarly, like that's why I would argue with value, right? Like there's nothing to really benchmark against, is there? I mean, depending because especially if you have so many idiosyncratic names that you're picking, like you could say like this is small cap value, but even that index is not going to be the same as your idiosyncratic. And then this goes back to like what Meb's always doing, and I think what he had Ken French on. It's like how much time when you need to determine if this person's lucky or good? It's like
Yes.
4 decades. Like, good
Yeah,
luck to you. Like,
I
no
know.
client sticking with you for that long.
That's a real issue for sure. And when you're more on like a at best probably a 3-year shot clock.
If that, yeah.
Yeah.
A quarterly shot clock, right?
Yeah.
but then if you had to construct these indexes from first principles, would you construct them the way that they have? I mean, float adjusted market capitalization weighted, that's a reasonable, like, why not? Why not do it that way? I guess. But then I wouldn't want to invest my money that way either. So I like the index makes perfect sense to me the way that it's constructed, but that doesn't mean that that's the way that I want to invest my money.
And then so to me, this is like so far this is a bad Santa kind of like this is like more of like a commiseration circle. Like this is remind me like I'm like, is this the Santas at like Alcoholics Anonymous? Like we're all just like commiserating with each other. It's like
Yeah.
how do we get out of this broken cycle? Because like yeah, it's just like like you said, always having to say you're sorry or having the differences because like it's if you take S&P 500, this is fascinating to me. Since 2010, so over the last 15 years, it's a 10 bagger. So like somebody's asking me on a
Mm,
podcast the other day, what would I recommend? I'm like, why would you listen to me at all? The S&P 500 is a 10 bagger over the last 15 years. Like think about, as we know, like how much that changed like boomer retirees portfolio. Peak earning years, like what are your savings 15 years ago? And you get a 10 bagger since then. And like, so it's just like, I like, who are we talking to? Like, right? Like it's hard to give any advice when, that index, obviously we all know at some time it turns, but the market can stay irrational longer and you can stay solvent. And so it's a really weird position to be in. Or we always say like people think that because we're long vol tail risk, we're perma bears. We're not at all. Like I'm an optimistic entrepreneur. And we always even say beware the white moose. And that's when your expectation is the black swan's going to come. So you get out of the market and then the market rips up for another 3 to 5 years. That's the white
yeah,
moose, right? So you missed out
yeah.
on all those gains. So like hopefully by
White
pairing
moose.
those, you end up in a bipolar schizophrenic portfolio that does fine in either of them. But yeah, it's just a weird thing that we're all dealing with constantly is like how do you manage your savings for a world that we can't predict the future?
Well, I think this is where, Buffett and Munger have, when they arrived at the eventual conclusion that you can't tell what markets are going to do. You shouldn't really listen to them. Don't follow them that closely, even. Focus on the business fundamentals, get that right. And a lot of this stuff is just sort of noise that over time will wash out. But use your CPU cycles on trying to understand businesses instead of trying to understand where markets might be going or why this is too expensive or, I mean, because it can just go, it might last a whole career potentially.
Yeah, that's what, there's so many things in there, Jake. Like you said, it could be. I always like to joke with my value friends. It's like, how many, dozens of companies are going to pick over multiple decades, right? That's not really statistically significant to know if you're lucky or good. I mean, we'd all take lucky. So, like you said, you might spend your entire career doing something that's, maybe not as accretive as we'd hope. And so it's like, but like you said, I'm sure you think about this stuff, Jake, is like, what do you do to do that? Especially when you have clients and everything. Like, it's interesting if you're Buffett, right? And you have a publicly traded equity where that money's basically locked up. You can say things like that, right? And you've earned that reputation. But for you to have the equanimity is one thing. Your clients is another. But then third, even outside of ourselves or our clients, is I mean, everybody I know checks their portfolio almost like every day, even if in retirement. Like, right? It's like weird thing. Like as you know, the Robinhood stats is like 8+ times a day. So like is there a vehicle? Is there a structure to like what can we do to get people to stop looking at their portfolios as they have for the last few decades? I'm not sure it's possible. Is there you got an idea on
Lose that login.
that?
I'm being glib, but I
No,
actually,
it's true.
it's probably a little true.
Did you see that there's a new addition to Fan Mag, Fat Man? I don't know what we're going with, but it's now Batman because
Batman's the newest.
Broadcom has now crossed $1 trillion in market cap, which means that it's now Magnificent Eight and it's Batman and it's like BAAT. There might be two M's, AN, something like that. Batman.
Are we just getting too old and curmudgeonly? I'm just so tired. We've seen how many name changes over the decades. I'm just so tired of all this stuff.
Well, what, what did it start out as? Was it only four? I want to say MAGA, but that's not right. What
No,
was
we
it
had
called?
Fang originally.
Yeah,
Fang, that's right.
Fang. I
Fang
think
was
probably
kind of
some
one
before
of the
that, yeah.
original, but yeah, sure, there was
But
probably
as we know, these
some
are
oil related one back in the
yeah.
80s, I'm sure was.
Well, and then before, yeah, we want to go way back. We had Nifty 50, and then like
Yeah.
like everybody's talking again about the bricks. But as we know, these are like made up by the investment banks or the ETF sellers just sell more product, right? Like they just try to figure out acronyms. So like, why are we participating in their acronyms to sell more product?
I just think it's funny. I think it's that you just add the thing that's working and you say, there we go. It's part of a cohort. There's a theme there.
But
Look
it
out for the
is
Batman
also a
ETF.
shorthand thing for guys like us to bitch about, right? So we could say like, well, of course I don't have Batman in the portfolio, right?
Yeah.
Now we all know what we're talking about together.
But could we just say like the top 10, I guess, or whatever? I don't know. Yeah, so we didn't have to keep learning new acronyms every time.
Isn't it crazy that American Airlines is at $10 billion? I noticed that when we went right in the middle of the pandemic, and I can't remember exactly, but when the airlines, I think when they all shut down, I went and had a look at the size of the airlines. And I was shocked at how small they all were. I forgot they were like 30, 40, $50 million against, that's what Fang earns in a quarter. Like that's what any one of Fang earns in a quarter. Like they could all have an airline if they wanted one. Wouldn't
Yeah,
cost
it's
them
like
anything.
I think it was sub 10 billion. I want to say it was like 8 to 8.5 billion market cap for America. I mean, I'm not gonna pull it up while we're talking, but like yeah, it was sub 10 billion.
That's crazy. What's
It's,
Fightcoin? It's probably
it's
bigger than
more.
bigger than American Airlines.
Gosh,
I saw somebody put out a stat that said that Fightcoin's now bigger than the entire Australian microcap market, which that was like $800 million or something. So I thought that was how much Fightcoin have you got in the portfolio, Jason?
Unfortunately, none.
Are
I
you
wish we did.
diversified?
yeah.
Yeah,
Conviction
diversified
on
enough.
Fightcoin?
What's your conviction of fart coin? How many shit coins do you own? What's the adequate amount of exposure to shit coins?
What,
It is.
did you and Corey consider that? Like, what did you go through all of the shit coins and have a look at anything that was sort of
Yeah. Well, we were both like trading some of those at that time. Also, like what I find too is like most of the time I tend to be early to things, which is another euphemism for wrong. And like yeah, we I was even looking up like we were doing we did our one of our first videos for Pirates of Finance. We did it on NFTs, and I want to say this is beginning of 21.
Yeah.
And we like created an NFT just to see what it was like and everything on like Rarible. And so yeah, we were like part of that first hype cycle. But even before that, I owned a bunch of crypto kitties and was like breeding those. And like that was a 2017. That was the first like true like but then like you didn't make any money off those. And then in the next hype cycle, you had crypto punks and like all this other
Bored
stuff. And I'm
apes.
like,
Yeah.
yeah, I'm bored apes. I'm like, what happened to the crypto kitties? That was the original, like, like way too early. So yeah, like it was during that last cycle. Yeah, we were looking at all the um not only like the altcoins and the shit coins, whatever you want to call them, but like all the different trading platforms too, where you could try to do all sorts of arbs and everything like that and try to, do some shorting and look at the delta on the spread on what, sometimes it was 20 to 30% interest that they were looking out to, like, to try to raise capital for trading. So there's all sorts of fun things you could do back then. I would call it cash and carry trade. And I think the cash and carry trade actually is back. But yeah, I mean, I don't know, I get kept pretty bored by it, and it seems like everything's just coming back around again. So it's just like, I don't know. But I feel like it's weird though. I like to stay on top of as much as we can. I mean, just because like you don't want to be get super old mentally and just be like everything the kids are into is a waste of time because like you never know what's going to come out of it. Like, and I actually hate all my like Australian economic style friends are always like talk about, malinvestment. And I'm like, is that true? Like today's malinvestment is like the future infrastructure, right? Like when we talked about, during when we were running all those cables underwater and, you had all those companies blow up in like, what was it, the early 2000s. And, that was malinvestment, but all that fiber optic cable was our infrastructure for everything we're doing now, right? And all of the malinvestment in crypto actually might go towards like, now with AI and everything, and you can't know if a video is real or not. Well, thankfully we have crypto there where we can figure it out like via NFTs and sort of KYC AML is like that can all be automated in the background to tell if something's real or not. And you can tokenize all of that to have it as proof of reality. And so maybe that's where that malinvestment, and I'm sure right now everybody's bitching about the malinvestment from AI, right? Like the amount of energy and servers it's going to take, but we don't know 10 years from now what that's going to be the infrastructure for.
I think that's a
I,
great point. Typically, though, the owners, the people who put the money in the ground, don't
Right.
do all that well
Right.
in these technological revolutions, just historically.
Early is wrong, like I said.
Yeah,
JT, I just realized we've gone past your.
it's fine.
Someone better mark the market. It's veggies time.
Veggies time.
All right. This is the end of the year here, and I think it's always useful to take a step back from everything and zoom out and focus on what's working, maybe what could be improved. And today we're going to take a look at a new book from Cal Newport, which might be helpful as we're evaluating, going into 2025. A bit about Cal before we get going. He's a computer science professor at Georgetown and a best-selling author. He does these deep dives into focus, productivity, and technology's role in modern work. And he earned a PhD in computer science from MIT, and his work kind of spans academia and practical advice. So I actually quite like him. His newest book is called Slow Productivity: The Lost Art of Accomplishment Without Burnout. And so let's like rewind the clock a little bit on productivity. So during the agricultural revolution, 10,000 years ago, you had a readily apparent crop yields that like how many bushels of wheat or rice or corn did you harvest per acre? And we had 10,000 years of iteration, cause and effect. Like, let's see what works, do more of that. And we found many efficiency gains like fertilizers, irrigation, the Norfolk four-course system of planting, which limits the amount of time that a field will lay fallow. And then a few hundred years ago, we entered the Industrial Revolution, and now productivity was measured by the number of products or widgets that were produced in a factory. And there was the obvious tangible metrics like piece counts and quotas that you could keep track of. And you were always measuring the output for a given level of input. And visible activity of the workers was a crude proxy for their productivity. So if you look like you were busy when you were working in the factory, it meant you were probably doing something good for the company. And this was the time of like Frederick Wilson Taylor, or Winslow Taylor, sorry. He was very infamous for doing these efficiency like consulting studies, way back in the day. And so like one of the things, like take shoveling slag iron in a steel mill. He designed a better shovel that balanced the desire to move more iron per scoop while also avoiding overexertion of a long shift. So, and in case you were wondering, the optimal shovel load is 21 pounds. That's probably for real men back in the day. I don't think we could do it. But all right, so then fast forward, and now comes the information revolution that we're living through now. And so organizing data and info for commercial activities. And we've accidentally kind of kept this old visible activity heuristic from our previous revolutions now in the information one. So, if basically the hypothesis, 50 years ago was like, if we all come into the office and we're there for 40 hours a week and we look busy, we're pushing paper around, like we must be good employees in a productive organization, right? We're good team players. We're going to jump on calls, respond to emails, book meetings, crank out memos. We're creating all of these really, like, you would almost call them like artifacts of like work. And if we're being honest, a lot of it is kind of performative busyness, right? Like you're just doing these things to hopefully the boss thinks that you're doing a good job. And you want to be seen as a team player, right? We're all playing this game. But many of these tasks, do they actually contribute to significant progress? And this is where like Newport has a term for this busy work. He calls it pseudo productivity. And he argues that this phenomenon is common in knowledge work, where workers often, they prioritize visible actions like checking off small tasks over deep focused thinking that would actually drive results. So, technology really hasn't been helping us that much in this front. Putting computing in our pockets through our phones. Now we're crowding out time away from the office where we used to, be home and focused, and now we're thinking about work and doing work. Rory Sutherland, who I'm, very fond of, has an interesting observation about technology. He says that what starts as an option becomes an obligation. So take like the clothes washer and dryer, for instance. This was supposed to save a ton of time for everyone who was hand washing their clothes before. But instead, what happened was the standards for acceptable cleanliness in public just went up. And now there was no real time ever saved. So an option then became an obligation. So, and there are lots of examples of this, smartphones and laptops, they created this beautiful option where we could work from anywhere. And yet it also ratcheted up the obligation that we all feel to kind of always be working. And all this hustle porn isn't helping, inbox zero. It's a bunch of craziness right now, if we're being honest. So the key takeaway here is that real productivity doesn't always have to look like you're busy. Like, imagine an office full of people with their feet up, pondering a vexing problem or reading a book that's maybe barely tangentially related to their job. And the boss comes in and loses their mind because it looks like it's all a bunch of waste of time. Yet that deep thinking and problem solving might be, or just going from an aimless walk that you might unlock something, could be how we need to tackle modern complex challenges. So yet I don't know like how many organizations are really allowing for that kind of deep work. So Newport organizes this slow productivity into 3 principles. Number 1, do fewer things. 2, work at a natural pace. And 3, obsess over quality. And I'll just quickly tackle each real quick. First is do fewer things. Newport suggests reducing your obligations to the point where you can easily imagine accomplishing them with time to spare, and leaving this margin of safety for your time. And what you want to do then is like leverage your reduced workload to advance a small number of projects that will matter the most, right? Focus is the key to the world. I'm fond of something that James Watson, the co-discoverer with Crick, said once. He said, it's necessary to be slightly underemployed if you're to do something significant. So anyway, be mindful of projects which carry a lot of overhead tax. This is like the administrative burdens of like you're gonna have a lot of back and forth emails. You're gonna have synchronizing meetings. Some projects have much more administrative burden than others. The second is to work at a more natural pace. Don't rush your most important work. Let it unfold over a sustainable timeline. Have variations of intensity, so like do sprints on it. And then find settings that are conducive to brilliance. So like make sure your environment is dialed in. And Newport cites these studies of hunter-gatherer tribes where even today, like, and you have to realize that a lot of the hunter-gatherers from today have been pushed into marginal lands, right, by agriculture societies. And even then, they're still only working like 20 hours a week to procure food and shelter. And here we are, grinding 80 hours a week. And then the last principle is obsess over quality. So and I'm not just saying put 50% of your wealth in Costco and 50% in a Visa, and then go read Persig's Zen and the Art of Motorcycle Maintenance all day long. That's capital Q quality. I'm just teasing. So Newport says that even if you have to miss opportunities in the short run, leverage the value of your quality output to gain more freedom over your efforts in the long term. So the world always notices and appreciates quality, whatever the modality that it's coming from. So anyway, these are just some things to think about as you head into 2025, start making New Year's resolutions, perhaps actually try to achieve less, but higher quality work might be just what the doctor ordered.
That's good stuff, JT. Jason, you're an entrepreneur and a business operator. How do you divide up your time? How do you think about that?
Poorly. There's so many things in there that JT said. First of all, shout out for extra bonus points for the Norfolk crop rotation system. Throwing that in there. Appreciate that.
Yeah.
Too. And it did remind me of the great writer Charles Bukowski. He always said I was a much better lover when I was unemployed. So yeah, it's focused on quality, right? And then you guys have probably read David Graeber's like Bullshit Jobs too, right? Like that's
I haven't, no.
Oh, that's so good. When he wrote like 5,000 Years of Debt, which is a great book as well. But it was actually just a kind of like an essay in a magazine, I think, that turned into a book. But it was just basically he was showing how like he believes like 60 to 70% of jobs like in America today are just bullshit jobs. Of like you're saying, like people performative work and like maybe working for a few hours a day. But it did make me think about let me see if I can always offend everybody on the podcast. It did make me think about like I always think about like UBI, right? Where the UBI comes from the government or I always thought UBI eventually would become from selling our own data back to ourselves, like through our attention. Like if you think about that hyper advertising and everything, it could eventually get to like a UBI price if they sold our own data oil back to us. But then it dawned on me the other day, I was like, oh shit, we already have UBI in the bullshit jobs. Like that's what it is like a bullshit job is essentially UBI for most Americans and our unemployment rate's low. And you're like, so at most corporations, you have all these layers of complexity where people are, basically getting coffee and on, TikTok all day. And, maybe they're overlapping with their responsibilities, but for the most part, they're just, planning birthday parties, and or team building. And so like maybe
I think it's some
UBI
of
is
these,
already here.
especially the tech companies. I'm not going to name names, but like I think they run make work schemes to avoid antitrust. Like if you saw how much profit there actually was in these things, if you didn't just have a bunch of people pretending to work, like the government would be coming quickly to their front door.
Right. But it's amazing to see like per employee, when you look at that stuff, it's anywhere from like $1 to $10 million in rev per employee these days. Like as you know, like that went, it used to be back in the day, you could use 3 to 5x your salary was like what you brought in for the company. Now, like you're saying, they're just astronomical, especially if you look at like Valve and some of these other ones, it's truly impressive. But going back to your question, Toby, is like, one of the things we do at our firm is we try to focus on quality. So it was tied right into what JT was saying. It's like, but then at the same time, I always can't help that little bastard in the back of my head is like, yeah, but is that really true? Right? Like that's what I try to say. We're going to slow down and focus on quality. Meanwhile, it's 10 p.m. and I'm texting my team like, where is this at? Like, it's like you want to do those things. It's aspirational to focus on quality and slow down, but I'm not sure with a smartphone and the communication we have these days, is that possible? And I just know I also don't believe in balance, but it's unfair for me to say that. I'm 46 years old, never been married, don't have kids. Like I work 24/7, and I enjoy that, having an unbalanced life. And so maybe that's what works for me, but it's probably not going to work for somebody else. And then these days, whether it's Cal Newport or others, it makes me kind of laugh as Cliff Asness said it perfectly the other day. I asked him about his morning routine, I think on like access returns, and he's like, Oh, yeah, I'd love to have more like, but most of the day it starts with me. First thing I do when I get up is I text my trainer, not today.
Yeah.
And then I go on my phone and I start looking at our positions and like it gets out of control. Then I'm late for my shower and then I just grab a cup of coffee and my cortisol's through the roof. And I'm like, yeah, that's most people's normal day. But like all these other people that want like a 2 hour morning routine, and if they don't get it in the right order, then they're fragile for the day. And like good luck if you're traveling. Like, and so like I aspire to all these things and I do read everything like Cal puts out and everything. It's just I'm just wondering how much self-delusion there is in our modern world that we have to deal with, right?
It's very true. I'm
Yeah, I couldn't agree
that
more.
was that advice was more for myself actually
Exactly,
to disconnect and spend family time that I may or may not be that good at.
I saw a good I saw a good video over the weekend on an organization called Radiant. This is a total left turn,
Hmm.
but there's an organization called Radiant. They're building nuclear reactors that are the size of a shipping container. Are you familiar with these guys?
No.
Yeah, you probably did you watch like I think it was John Coogan was originally did some videos on that. Maybe that was what you or something else. Like he's doing a lot of those kind of videos.
It's possible, yeah. So what's the, I don't know who John is. What's his
I think
channel
his
called?
I think his channel on YouTube might just be John Coogan. So John was one of the co-founders of what was it that Soylent Green or whatever, like that shake and
Okay.
everything. And he's a entrepreneur in residence for Founders Fund now.
Okay.
But yeah, he started like his own channel and he was doing a lot of these companies. And he also does Technology Brothers now with Jordy Hayes, which is another great podcast that just came out. But it's actually Toby, it's actually right in your neck of the woods is the whole
Yeah.
gundo now. Have you heard this term even yet?
No,
What
no.
the kids are calling it. So you know how all this new defense tech started with all these 20-year-old entrepreneurs, and a lot of it was focused around El Segundo. Well, now obviously it's branched out, you know, with you have Palantir's what down in Orange County and everything. So it's that whole LA coast, they're calling the Gundo now. And that's when been one of like now if we want to end on an optimistic note for this holiday year-end special, it's like that's what's been fascinating to me this year is getting to know a lot of these 20-year-old entrepreneurs. They're actually really conservative. They want to have like more kids. They're typically tend to be more Christian, and now they're all about American exceptionalism, bringing manufacturing back and defense technology
Yeah.
in America, and like the cutting edge of defense tech or manufacturing. And part of it is, you know, having these portable reactors and everything that can power cities. It's like, you know, one, you know, how do we get better, you know, sources of energy, but then using, you know, advanced defense tech too. But also those go hand in hand kind of with each other because how do you power these things at remote locations?
Hmm.
Well, that Hadrian
Yes.
is the big manufacturing, and they're right down the hill from me. I went and drove around there just to sort of see how big it is. I've been watching the videos on because Hadrian is this like aerospace manufacturing is where they're focusing, but they're like an outsourced manufacturing. They have the factory floor, and you can send them the wireframes, and they will
It's like the
build.
Foxconn for
Yeah, it's there's some really interesting tiny things that really make a huge difference that Hadrian does that I found fascinating. And one of them is like they can automate it. They've automated the sizing of like all the drill bits and everything on the machine so they can interoperate them quickly. But more importantly, when they're cutting metal or anything, they can see the friction time wearing down so they can easily switch back and forth between tools so you don't have that downtime. So it's really simple things like that that are really making a cutting edge difference in like Hadrian's manufacturing.
The space that they have is huge. I drove. It's really close to where I am. It's just down in Torrance, but if you can the it's vast. Like the amount of space that they have. I was driving. It takes it's like a 5 minute drive down the side of a block, and it's all Hadrian space that they're going to build into. They've only got a few warehouses there now, but it's kind of incredible. But that combination of the portable nuclear power from Radiant and Hadrian building those things, it makes me think that there is something very interesting going to happen over the next 10 or 20 years. Plus, with that, I don't think that the AI is quite there yet, but I think it's getting pretty close. I don't think anybody's really figured out the killer app. Like, I don't think that ChatGPT is really it yet. Have you seen anything that's sort of like I need more automation. Like to have a
Yeah.
true you know assistant or anything like that. You need to be able to tell it to do stuff and have it go away and do it. And none of them interact as far as I can see
Oh,
right
well,
now.
it hasn't figured out how to buy stocks that go down.
Yeah, I do that all by
yeah,
myself.
I can do
exactly.
that one.
Where you can automate the podcasting and the stocks that go down. Yeah, that can easily done yourself. So, well, I got a good one for you then. Agency AI, or it's agency.ai, is done by Dharmesh from HubSpot. And the idea there was kind of brilliant. He's like, why wouldn't we have a job board for AI bots? And so what you can do now is like previously when you used to link all of your different flows and systems through like a Zapier and you're trying to automate that whole process. Well, now you can use very specific agency bots or AI bots to do very specific problems, and then you can tie them all together in that automation process. So we've been playing around with a lot of this stuff, but like to your point, it's still not quite there, but it's getting better and better, and so it's just a matter of time. But now, yeah, you can use ones that are hyper focused, and then you can link them up. And kind of bricolage them all together to have your automated system. I mean, yes, there's not like a true killer one-stop shop for all that stuff, but that's it's coming, and I think we've been messing around with a lot of it. It's been very interesting, but it'll kind of work itself out over time. The only other thing from a finance perspective that I also want to maybe hedge with is you have to be very careful about what's actually in the code for a lot of these bots and everything. And there's can be some backdoors, bugs, and some nefarious things kind of in the code. So you got to be very careful in running a financial firm on what you're using kind of in your back end. That's more appropriate than people realize to really dive into.
That's good to bear in mind. What about quantum computing? That thing that was it Google with Willow? If I got that
Willow.
right.
What do you, I just like, I feel like all these questions just show how big of an idiot I am, or I'll just pontificate about anything
No,
and
it's great.
anything. I'd rather
You're an
hear,
entrepreneur. I want to talk to
I,
someone who's like,
I'd rather hear Jake's take on it. So one, I'm too dumb to know if what they came forth with Willow is actually amazing or not. And it sounds like the proxies they're using to show how great it is there's no way of verifiability. So I'm much more in the, what is the, what can I think like for, science has to be falsifiable. Why can't I think of the name? Jake, you got me on that. Don't, I'm putting you on the spot too.
Karl Popper, I think
Popper.
is,
Thank
yeah.
you. Popper. Yeah, Popper is falsifiability. So I'm not sure how falsifiable it is with the Willow chip. But what I think it does open the door up is now we know we're maybe a few years away from having full on quantum computing, but it's like how many qubits can you use? But like, one of the big things people said, well, then Bitcoin's dead. But like Bitcoin saw this even in the white paper with Satoshi that like that was eventually going to be a problem. And so they'd have to change the security around that. But I think it was something like it would take like 10,000 qubits or 8,000 plus to be able to break the to break Bitcoin. And right now the Willow chip I think was like 106 qubits. So like it's still a long ways to go. And I think things like, Bitcoin will adapt and everything. But like I'm more as an entrepreneur and just a general optimist is like you think about like this stuff's all cutting edge and you're like how tuned do I need to be to it? It's like eventually it's all going to be like in the back end of our phones, right? Like, and it's
yeah,
just amazing the world we live in. Like, like that we're able to do this, right? I was in your guys' neck of the woods in California last week. I'm in Chicago. We're on Zoom. Like all of this stuff we still take for granted. It's like the old bit, like, everything's amazing and nobody's happy. It's like I just flew through the air on a magic carpet ride, and if the Wi-Fi went down for 5 minutes, I'm pissed. Like this shit's amazing, and like, and that's what you're saying, like the energy sources, if we can improve those, like, because I think that's what, and Jake would actually really know the history on this too. Is like if you look from whale oil to wood burning to sources of energy to fossil fuels, and then like eventually as we're progressing along that's what really builds human ingenuity, GDP, and our welfare is like the energy sources and the cost of those energy sources. And like that is constantly improving too. And hopefully the zeitgeist is moving around that window back open to, to nuclear. And by the way, I very specifically have a hard time saying that, and I've been trying to avoid it because it's one of those weird things about my idiocy is like I cannot hear the difference between nuclear and nuclear. And my fiance makes fun of me all the time. And like all I say is all you're proving is you're an asshole. But like it's just one of those things I can't hear the difference, so I'm trying not to say it.
uh, elemental energy is the
There
real
you go.
point.
Yeah, there you go. Yeah,
Yeah,
that's how you get
that's the
around that.
Josh Wolf, right? Trying to
Yeah,
rename
that's
it
it.
as elemental energy.
I think it's a
Yeah.
good idea.
It's smart. Yeah, it's clever.
But
mean,
yeah,
this,
hopefully you would just, and I think it goes back to lab too, is you just want to diversify your poisons. It doesn't mean elemental, we should switch 100% to that, right? It's just like over time, like spreading it out a bit. Yeah. And because we don't know what's going to truly kill us, where it's really easy to see through coal and everything, how that's killing us. But like, you just, or it's harder to see actually, I think, is like people don't see over time, how much that affects us. So it's easier to see like a Fukushima disaster or 3 Mile Island, but like, and then over history, you're like, what was the actual death toll? What were the downside effects? But it just sounds much more like dystopian, I guess.
I just think the fact that you can have these portable, I mean, the fact a portable nuclear generator in some ways sort of solves the problem of Fukushima. You just drive it out of the way if it's coming.
Yeah, they have like shoebox sized ones that you could like bury in your backyard and run like a city of like 1,000 to 5,000 people. Like if like our entire waste, if we just used all elemental energy, would be the size of a coffee can I mean a Coke can. So like yes, you do have the half-life effects and what does that radiation dissipate over a lifetime? But that's pretty amazing to think about that it's the size of a Coca-Cola can for your entire energy needs over like an 80-year life cycle.
I saw kind of a funny, I don't know if it was a comic or just an observation, but it was like, imagine if fire, we'd burn down something we didn't want to burn down like twice when we had fire. And so we're like, oh, no more fire. No, never touch fire again. Like, I mean, that's basically what we did with nuclear.
Gents, on that note, we've made it to the full-time hooter. We've done it. Jason, if folks want to follow along with what you're doing or get in contact, what's the best way of doing that?
On X Twitter, I'm at Jason C. Buck, JASONCBUCK. And then you can find me and all our writings, podcasts, etc. at mutinyfund.com.
JT, any final words?
Looking forward to a little break. Happy holidays to everybody. I think we'll be back in the new year, right? Is that correct, Toby?
We will be. Yeah, I think we're January 7. We've already booked a guest, and then we've booked our January 14 guest as well. They're two bangers. We've got O'Shaughnessy and Rasmussen coming up.
Oh, let's go. All right.
Which O'Shaughnessy, though?
Jim with his new book.
The Elder Statesman.
Great. Happy holidays, gentlemen. Thanks for having me on.
Thanks, Jason. Thanks for coming on. Always fun.
Merry Christmas, everybody. Happy holidays, season's greetings. Enjoy the break.
Kwanzaa.
Spend some time with your family. We'll see everybody on the other side.